Good morning, everyone. So welcome back to Morning Kappa. So today I would like to start the session with our budget 2026 review from the macroeconomic end, which we think that for this year, the budget 2026 is actually set to support the growth via three main channels, which first of all, the stance is remained as mildly expansionary and as set to support the growth through three main channels, which including spurring the public and private investment, promote inclusive and sustainable development, coupled with a strengthening of the business climate. So the allocations for 2026 is at around 4.19 billion ringgit from the central government, which accounts for around close to 20% of next year GDP. So while the fiscal deficit target is continued to set at a lower target of 3.5% of GDP for next year, so versus 2025 fiscal deficit target of 3.8%. So this actually underscores the government's commitment to sustain the economic momentum while enhance the fiscal sustainability. So with the theme of fourth Madani budget, people's budget, so budget 2026 do place an emphasis on inclusive and sustainable growth amid the external challenges while laying a solid foundation for Malaysia's medium to long-term development goals. So basically, we're seeing that budget 2026 from the macroeconomic end as growth supportive and core of five key aspects as what we anticipate earlier on. So such as fiscal sustainability, economic stimulus and infrastructure development, social welfare and inclusivity, strengthening the business and investment climate, and advance ESG priorities. So our GDP growth forecast for next year, so based on the budget measures itself, still being maintained at 4.7%, so which is upside bias relative to government's forecasted range of 4 to 5%, 4 to 4.5%. So why we are more optimistic? Because our optimism is anchored by, firstly, we are seeing that there are some upsides of domestic demand in next year. Secondly, a relatively sanguine external outlook as tariff risk potentially ease or dissipates on next year, coupled with a budget expansionary fiscal stance. So from the official statement itself, so we are seeing that the officials are relatively cautious on the external sector outlook on next year due to, firstly, we are likely to see a full year impact of the tariff from US on next year, or secondly, they are seeing some risk from the from the sector specific tariff from US on next year, so specifically on the semiconductor. But for now, we are relatively still holding a constructive view on the external sector outlook on next year, while we are seeing that the lingering uncertainties surrounding the US tariff policies may actually warrant continued vigilance, especially we are seeing that there's a recent threat from US to impose additional tariff on China. So we are seeing that there's limited cause of concern at this stage, as we're seeing that there are more clarity is expected on several fronts, so which including the forthcoming US Supreme Court ruling on the legality of the Trump era reciprocal tariff. Secondly, the potential introduction of the sector specific measures targeting semiconductors, which we think that the risks are limited in the near term. So given that our deep integration into the US supply chains for the semiconductors, and lastly, the evolving implications under the TACO scenario, which historically points to tendency for policy reversals following tariff threats. So we are keeping our GDP growth forecast for 4.7 for now. Secondly, our private consumption forecast for next year is at 4.2%, which is slightly higher than the official estimates of 5.1%. So we are seeing that there's several upsides from the consumption side, so which including, first of all, for next year, so upsides risks to consumption are likely emerge from in contrast to what we estimate earlier on, there's an absence of SSD rates or coverage revision for this year, particularly in some of the key sectors such as telcos and food and beverages services, which we think that will actually help to sustain the household spending power. Secondly, there's a lack of clarity or announcement on the targeted RON 95 fuel subsidy measures tightening, whether they will be extended to the higher income group, which we think that based on the budget 2026 announcement, so next year it will likely to still benefit more than still likely to be maintained as per what they implement in this year. So which means that it will benefit more than 50% of the petrol consumers by volume. So given that the T20 group actually accounts for over half of the total fuel consumptions. So this actually suggests that the disposable income growth may remain more resilient than initially anticipated. And then in addition, the allocation for SDR and SARA will be raised to 15 billion under the budget 2026, which is higher than 30 billion announced in budget 2025. So while additional one-time 100 ringgit SARA payment to 22 Malaysian aged 18 and above in mid-February is expected to add upsides of around 0.1 to 0.2 to the GDP growth, consider higher government spending and also multiply impact from higher consumer spending in next year. So all of this actually still points toward that reinforce our GDP growth forecast of 4.7% on the next year. So investment growth in 2026 is expected to be driven by development expenditure, approximately 81 billion. So with largest allocations directed towards key sectors such as transportation, public utilities, and also trade and industries. So key initiatives such as infrastructure modernization and upgrades, public transport expansion, and green transition are expected to further support the public investment in medium term and short term, so crowding in additional private sector participation as well. So in terms of inflation-wise, so based on the budget measures itself, we have revised our 2026 inflation forecast to 1.8%. So versus our previous projection of 2.3%, which is now aligning with the upper end of the official projections of 1.3 to 2%. So basically, the downward revision reflects the absence of policy changes previously anticipated. So specifically, there's no broadening or rate revision of the SSD, and there's no further tightening of the raw 95 fuel subsidy, which are expected to target the higher income group. So which means that the policy continuities from now are likely to actually temper the cost pressures and help to maintain the price stability in the next year. So however, our projections still remain at the higher end of the official range. So given that which is consistent with our more optimistic view on the domestic demand condition and also anticipated firm growth in the private consumption due to those expansionary fiscal measures on next year. So from the fiscal end, so we are seeing that the 2026 fiscal deficit target of 3.5% of GDP is to be realistic and achievable. So given that there's a continued revenue-based expansion and ongoing subsidy rationalization initiative. So some of the revenue contributor on next year, we including adjustment on taxes on unhealthy consumables, so including tax on tobacco and alcoholic products, and also the phased implementation of the carbon tax, beginning with iron, steel, and energy sector on next year, further actually supported by the expansion of the e-invoicing systems as well on next year. So further out, we are seeing that there's a contribution from the SSD itself, which having a double-digit growth for 2025 and 2026 actually anticipated, which actually helped to contribute to the largest share of indirect taxes. So coupled with a government to have a savings of around 15.5 billion itself from ongoing subsidy rationalization, including the free floating of eggs and chicken prices, rationalization in the electricity tariff, and also fuels, including diesel at RON 95, which we think that will help to attain the fiscal deficit target of 3.5% for next year. So that's all from me. I will pass the line to the next presenter. Thank you.
All right. Okay. Thanks, Sian. Okay. Hi, morning, traders. Welcome back to Kappa. Aiman here. Okay. So looking at the S&P 500, well, it fell sharply on Friday, last Friday, as the market, I think, repriced in the raise of the renewed US-China trade war, including Trump's 100% tariff threat and the concern over export control. So tech and also some growth names, especially those exposed to China, were to burn of decline. So we view this as a risk event rather than a breakdown, but it certainly raises volatility risk going forward. So Technical wise, we view this as a one-off event, and also judging by the technical trend, it is still bullish overall, despite the drop testing the 50 day SMA lines, right? So at this juncture, watch out for support at 6,500 point level. So looking at the China A50 futures, also it fell sharply last Friday. Like what I mentioned just now, China was pressured by renewed trade war anxiety. Also, Trump floated 100% tariff and export control on Chinese goods, right? So tighter rules on rare earth export from China added fuel to the race narrative. Well, I think the fundamental remain solid. The drop shows that how sensitive the market is towards the policy risk and also the global tension, right? So, if you look at the charts here, the index dipped by around 4%, 4.26%, reaching the 14,700 points. And I think if the bearish momentum strengthen, the index is eyeing for 14,000 points. And I think at this juncture, investors are expecting for a rebound at this psychological support, right? So moving on to our Hong Kong trading stocks that we have published today. So we have China Mobile 941. So the stock is on its pending breakout formation, testing the 85 dollar resistance level. So if the bullish momentum to remain steady and breach this level, we can expect to test the next resistance at 88 dollar before it climbs towards the $91 level. Now, if the momentum to reverse, make sure to have a stop loss at 82 support. Right. So up next we have Industrial and Commercial Bank of China 3098. So if you see that the stock is now eyeing to climb higher after the rebound, now if the price able to continue to maintain higher, it may breach above the $5 and 75 cent. We might see that the stock to touch $5 and 90 cent level before it might propel higher towards the $6 and 10 cent level. So a reverse below $5 and 55 cent would open the door for a deeper correction, right? So looking at the WTI futures, well, it is getting mixed signals recently. Recently it rallied after OPEC Plus raised output modestly, easing the oversupply fears, but gains have been kept as geopolitical risk threats. Meanwhile, the EIA is also, the upward revision in US production and cost pressure on the shale players are reminding the market that oversupply is still the headwind. So if you take a look at the charts here, it breached out below the $60 level recently after rejecting the moving average here. So if the bearish momentum to sustain, this black gold could dip lower towards the 57 support level, right? So coming back home, back to Malaysia, so the FKLI slipped last Friday by almost 1%, 1.04%, as investors turn caution and also adopting wait and see approach on the budget 2026 and reflecting weaker regional cues. Right, so the market moved defensively with broad weakness across the sectors, right? So I think the drop lacks of major negative catalyst, but it signals that investors are pricing in uncertainty on the budget details and also the global market jitters reflecting the major market. So trend are now still pretty much bullish for FKLI, and we still hold positive bias for the index. Resistance remains at 1675, followed by 1,700 points. Right. So last Friday, the only sector that added some gains was coming from the energy index. Right. So now if the index traveling I mean, now the index, the Bursa Energy Index, is traveling in its an upward trend channel, right? Notching higher high structure and potentially hiking higher towards the 800 point psychological level, referring to the technical analysis. Right, so referring to our watch list, if you're keen on some of the energy names, of course we have some related counters, Valesto, LFG, Dialog, and others, right? Okay, so just following up with you here on CETOs that I mentioned last Thursday. Yeah, Thursday. So the stock is now pointing higher and managed to stay above 95 cent resistance level. So what can we expect next? I mean, for us, we can expect to see and expect the bullish momentum to remain steady and strong. We need to wait for the MACD line to cross above the signal line in the coming session. So with that, the vision to achieve this 99 cent resistance level is much clearer. Also, we talked about the energy sector just now, so I would like to bring your attention to Heng Yuan right here. So the stock managed to form a bullish engulfing pattern last Friday at the high volume level, referring to this volume profile. And now looking at the Fibonacci projection, I would highlight few or some important resistance level, which is this 99 cent, 99 cent level, 2 cent, and also 5 cent level. Right. So moving on to our Malaysia trading stocks, we have IJM today. So the stock is in its pending breakout formation at 2.80 cent. With that, we expect the momentum to remain steady and the stock able to climb higher towards the next resistance at 2.90 cent, followed by 3 ringgit level. So if the stock breach lower or clear the 2.70 support, this might signals a further pullback. And also next we have EG Industries. So the stock recently has experienced a breakout, and now it's on its pullback move. However, we're expecting for the price to breach the 1.40 cent resistance level in the coming session with high volume. If the bullish momentum persists and continue to trend higher, the counter might climb towards the 1.50 cent resistance. Second resistance is at 1.60 cent, so do watch out at a 1.30 cent support for any time of reversal. Right, so lastly we have FCPO right here. So it pulled back slightly on last Friday. So the retreat, I think the retracement looks driven by mix of rising inventories, right? So also a weakening signal from the rival oil and also crude and profit taking after the recent rally. So I believe the broader trend still faces headwind unless demand or export flows improve. We still hold a negative trading bias for FCPO, aiming for 4350 level, followed by 4250 level. Right, so I'll stop here and pass the floor to Alex for the market strategy. Thanks and happy trading, everyone.
Okay, thanks, Aiman. Morning, everyone. Thank you for dialing in to Morning Kappa at 8. Let me just quickly run through the budget announcement, some of the key highlights. I think you've heard the economic part from my colleague Sian earlier on. I won't repeat all that, and just focus on some of the impact on the equity market. So I think overall, if you want to look at the impact of the budget on the market, it checks all the boxes. Nothing that PMX and Finance Minister missed out. I think it was, it's fairly comprehensive exercise in fiscal discipline. There were initiatives to show commitment to reform. There was also a focus on some of the lower income groups with more continuation of the cash handouts and obviously the development expenditure allocation of 81 billion that will continue looking to strengthen the country's infrastructure network. Right now, I think on the there were some initiatives impacting the consumer sector, but my colleague Siang will be presenting his notes on Carlsberg and Heineken shortly after this. So I will leave him to elaborate, on some of the key implications for the consumer sector. Elsewhere, I think, as I mentioned, construction well featured as usual. We think that while the 81 billion allocation was a small increase over 2025 allocation of 80 billion, but the development expenditure trend being the first year of the 30 Malaysia Plan usually has is usually allocated in a rising trend. So we continue to have a 430 billion allocation over the 5-year plan, which works out to about 86 billion on average over the 5 years. Essentially, we continue to expect a year-on-year increase over the entire 5 years. So I think while there were a lot of explicit mentions of smaller projects, flood mitigation projects, road improvement, bridges, and so on. There were no explicit mentions of the big ticket, high value projects, which includes MRT3, Kia Singapore High Speed Rail, and also the JB elevated autonomous rapid transit projects. But we believe that going forward, these projects will continue to see some element of focus going forward. Elsewhere, I think if you look at autos, it wasn't specifically mentioned in the budget, but in the MOF, Ministry of Finance fiscal report, they confirmed that the tax holiday for CBU EVs will end by end 2025. And this is in line with what what we have been expecting, given that the focus now, having developed a reasonable baseline population of EVs with the car buyers now more familiar with what EVs offer. The focus is now on attracting foreign the car EV manufacturers to actually set up shop to locally assemble their cars here. As you know, Proton has already started their local assembly initiatives, and Perodua is expected to follow by the end of the year. And we understand from news flow that BYD's plant is also on track for a commercial opening sometime in 2026. Okay, elsewhere, I think it's probably fairly neutral for the auto sector. And construction, I have mentioned earlier on. On consumer, we will talk about that shortly. Let me quickly. There was obviously talk on. There was also mention again of carbon tax that is supposed to be implemented in 2026. This is in line with the national carbon market policy and also the national climate change bill. But that obviously from where we're sitting right now, there are no specifics on this tax, and as how in terms of who will be affected and how the tax will be calculated. Elsewhere on oil and gas, we also had a lower Petronas dividend of 20 billion, which is down about 37% year on year, on the back of lower oil prices generally. Property market, property sector, the other equity sector that is typically gets a lot of headlines from budget announcements. Overall neutral. There weren't any kind of significant measures for the property sector, whether positive or negative. And we think that there were some, while there were some concerns over potential tightening measures, there weren't anything major. Some of the full stamp duty exemptions for first-time home buyers for houses priced up to 500K is extended for 2 years. So that's a positive, but it's not new. And elsewhere, the higher stamp duty rate for foreign purchases isn't going to be particularly impactful for the market. Elsewhere, I think we also saw an announcement on Visit Malaysia here, and there was a huge 700+ billion allocation to promote Visit Malaysia here. Malaysia is looking to attract 47 million visitors in 2026. That will have a huge knock-on impact on sectors like consumer, commercial REITs, transportation, airlines, and hospitality, and so on. So I think overall, the anticipated pickup in visitor arrivals in 2026 on the back of VMY 2026 is going to be bode well for the overall growth of the economy. Elsewhere, we also saw some long-term initiatives that is a mild positive for the tech sector. There was a lot of focus on AI initiatives and how the government is going to pivot around towards using and developing more AI initiatives, both on the backbone and in a mainstream side of the government activities. Okay. Elsewhere, finally, we had a lot of emphasis on ESG initiatives that I think strengthens Malaysia's credentials from the green aspect. So a lot of information there. You can sort of read that for yourself. But so overall, again, to summarize, budget pretty neutral, and I think the impact on the market today will probably be overshadowed by developments over the weekend with regards to Donald Trump's threats on more tariffs on China. And it does look like the US-China trade war has taken a turn for the worse. But if we think that Trump has inherent taco tendency, so any kind of pullback in the market on the back of this so-called worsening of the trade situation could be an opportunity for investors looking to position for 2026 to start nibbling stocks that retreat on weakness. Okay, so I think right now we need to see how the overall trade situation evolves. All right, that's it for me. Let me pass the time over to my colleague Siang.
Okay, thanks, Alex. Let me continue with our company updates on the two breweries under our coverage, namely Heineken and Carlsberg. Okay, as Alex has mentioned, the excise duty on alcoholic beverages, including beer, will be hiked by 10%. This will be effective 1st November 2025. To recap, the last increase took place in March 2016 when it was rebased from excise per liter of beverage to excise per liter of alcohol in beverage. So we expect the brewers to fully pass on the excise duty with an price adjustment of between 4 to 5%. Having said that, a mitigating alternative is to lower the alcohol content, but we believe this will require an outstanding R&D effort to reformulate the products without affecting the taste and quality. We are negative on the excise duty hike. We highlight the last excise duty hike in 2016 did not result in material or adverse earnings impact. In fact, if you look at the numbers, Heineken and Carlsberg Malaysia operations recorded earnings growth of 9% and 15% respectively after the last excise duty hike effective March 2016. But having said that, beer prices have been raised twice in April 2024 and August 2025. And hence, we believe the upcoming increase to pass on the excise duty could see a stronger impact to demand. This is after also considering the soft consumer sentiment on the back of inflationary pressures. So with that, contraband trades could capitalize on the wider ASP or pricing cap. Post-budget, we are cutting our numbers by between 4 to 3% for Heineken and 3% for Carlsberg in 2016 and 2017. We expect a muted impact in 2025 as a heavy front loading is anticipated in October before the higher excise duty kicks in November. We foresee the companies to intensify their marketing efforts in stimulating the consumption. Meanwhile, the commitment to Visit Malaysia and the budget allocation to drive Visit Malaysia campaign could drive higher volumes for the breweries by accelerating the robust momentum of tourist arrival. On top of that, profit margin should remain elevated, underpinned by the recent price increase, continuous efficiency gain, and favorable input costs and forex. And hence, we expect the generous dividend payout ratio to remain. Overall, we are negative on the development, but we think this could be already in the price with the stocks trading at well below their historical mean. Demand could be dented in the immediate term before eventually normalizing, and margin expansion and the premiumization strategies will continue to be the primary drivers for earnings growth and high dividend payout. All in, we maintain buy on Heineken and Carlsberg with target prices of 26 ringgit 50 cent and 20 ringgit respectively. Let me stop here, and this will be our last report. Happy trading, and hope to see you in our next morning cuppa at 8. Thank you everyone for joining us this morning.